Welcome. I am Brian Emery, co-president, along with Kent Novell of the Brotherhood at Temple Beth. I must say, wow, what a great looking crowd we have this evening. Looking at the screen is like looking at a jumbo Hollywood Squares board. So may I suggest you sit back and relax, put your feet up, make yourselves comfortable, and act like you own the place, unless you're renting. This is quite a turnout for our first Brotherhood program under challenging conditions. 84 of our Brotherhood members and Temple Bethel congregants have signed up for tonight's event. And we're not even providing food or drinks. That's awesome. The turnout is not a surprise, considering our featured speaker has packed Silverman Hall for years when he shared his economic insights. Tonight, Silverman is dark, but our screens are bright, and yearning for his unique views on this unprecedented nexus of the economy, the election, and this pandemic. We want to thank the hardworking staff and clergy of Temple Bethel for hosting this important meeting and appreciate all they have done and continue to do for our congregation. The Brotherhood has also been working on exciting programs ahead, which we believe you will find rewarding. Co-President Kent Novell will have more to say about that at the end of our program this evening. And now, Bishop Sheen, our program chair, will provide us with an overview of when and how to ask questions, and we'll introduce our guest speaker. Bishop?
Thanks, Brian. And welcome, everyone. We are really pleased to have all of you join us featuring our nationally acclaimed economist, Mark Vitner. Mark, many of you know Mark. He's been a Temple member for 25 years or so. He is the managing director and the senior economist at Wells Fargo. Mark has, if my math is right, 36 years of experience with financial institutions tracking national and regional trends. Now, you often see Mark quoted in all the leading financial publications, speaking on all the major networks and the websites. His credentials are wide and deep and way too long for me to summarize them here this evening. But I know Mark for, 3 decades. We met in preschool. His batting average on spotting trends ahead of the crowd, it's major league. And well, the folks who do not pay attention regularly to Mark and didn't listen to him 6 months ago, they likely ended up long on cruise lines and short on toilet paper. Mark really understands all the trends. So he has a great presentation ahead for us this evening, and we'll have ample time at the end to handle all your Q&A. Now, here's how you can get in the queue when we open the form for your questions. Depending on whether you're on a device like a tablet or whether you're on your computer, Mute has settings, as Zoom has settings, and the settings would either show as more, where you click on that and there'll be a thing where you can raise your hand virtually, or it will say reactions, and then you'll find the raise your hand or lower your hand in there. But we'll cue you when it is time to line up for Q&A. And you will raise your hand virtually, and that's how we can call on everyone in the proper batting order. You'll unmute yourself when it's time to ask your question, and then after you've asked your question, we ask that you mute yourself again. Please, everyone, try to keep your questions well edited, and it's really best to avoid long speeches so we can get to everyone. So thank you again for joining us, And please welcome our friend and Temple member, Mark Vitner.
Hope. All right, there we go. I thought it was going to be seamless. Is that up there for everybody? Hopefully. Well, Bishop said that I was a great forecaster in COVID. I tell you, I wish I was. I mean, I was with just about everybody else. The last week of February, I was traveling in Texas and Florida, and you know, it started out the week in Houston, and you know, at the start of that last week of February, folks were still pretty much convinced that COVID was something that was going to be a threat to the global economy, Asia, not maybe supply chains here in the U.S., but not a health threat to us. And went to Tampa from there, and by the time I finished up in Tampa, it was pretty darn sure that I was a little worried that the flights wouldn't be going that weekend because I had to go to Texas again from there. And you know, it really came on, you know, in terms of being a health threat fairly quickly. The economy began to shut down really the second week in March, and the shutdown was so sudden and it was so abrupt and it was so complete that even though we had a very strong January and February, if March was just flat, the first quarter would have had probably 3.5 to 4% GDP growth. But because things weakened so much in the month of March, we wound up with -5%. That's how much everything fell. Now you've seen the second quarter GDP number that, you know, has a decline of 32.9%. That decline actually appears to have bottomed out in the middle of April. So all of the drop in economic activity occurred in about 5 weeks. It's the shortest recession we've ever seen on record, and the economy's been growing since then. And we're on pace right now for the third quarter for about a 25% increase in real GDP. So it'd be the largest increase in GDP that we've ever seen, following the largest quarterly decrease that we've ever seen. I've got a little bit of an outline I was going to go over real quick, and kind of picks up on that first point. After bottoming out in April, economic activity bounced back in May and June. But as you're well aware, we had a resurgence in COVID cases. And one of the things that I learned very early on, the stock market was in free fall back in March. And people say, well, you know, how far is this going to go? And I said, it's going to keep dropping until we get some clarity as to how bad it's going to be and what type of policies are going to be enacted to counteract it. And you know, that's pretty much what had happened. Well, even when something goes wrong, we get information. And the fact that COVID cases increased as economies opened up is valuable information. It's valuable information going forward, because it tells folks, hey, we can't open up as quickly as we did previously. With the rise in COVID cases, we saw that consumers and businesses began to disengage from economic activity in mid-June and July. Now, we also had the unrest around the country. And, you know, I've seen some reports, I've seen some research that hasn't been juried, it hasn't been peer-reviewed, that claims that the unrest had nothing to do with the uptick in COVID cases. There's absolutely no evidence that that is true. We saw that with the protest and the unrest in the cities, we saw a decided change in who was coming down with COVID. It was much younger. It was a much younger population than we saw previously, and it hasn't gotten sicker, but it plays into that younger cohort being subject to COVID plays into the dynamic that has caused most of the decline in economic activity and most of the increase. If you look at where job losses have been the heaviest, they've mainly been restaurants and hotels, and primarily restaurants. Over 40% of the jobs that have been lost at restaurants. And there's a very strong inverse relationship between the heaviest job losses being in the lowest paying industries, and the highest paying industries have seen the smallest job losses. And that helps explain why home sales have been so strong. And it also explains why car sales have been strong. It doesn't really explain the strength that we've seen in consumer spending. And I'll get to that in just a second. But along with the drop in retail, drop in leisure and hospitality spending, and drop in experience retail spending, which is health spas and fitness centers, all of those CrossFit things and things of that sort. All of that's been hit pretty hard. The other thing that was a little bit surprising was the shutdown in healthcare, and very few people saw that coming in the numbers. Where doctors' offices and therapist offices had to shut down, and that put a lot of their hourly support staff out of work. And next to leisure and hospitality, the largest job losses were at doctors and dentist offices. After that was retail trade, after that was other services. Well, we've seen employment come back very strong the last 3 months. And in some respects, if you look at the graph in a certain way, it looks like a reverse check mark, or you could even make the case that it's a V-shaped recovery. We don't see it as a V-shaped recovery. What I think is we're going to see is sort of the Nike swoosh but it'll be bouncing along that, where we'll have some periods where we'll have good economic news and good news about the virus that'll bolster confidence. And then we'll have some periods where we get some bad news. And going into the fall is got a lot of unknowns. My oldest started up at Appalachian State, and unlike Chapel Hill, they seem to have a pretty good plan in place. I still don't know whether they're going to be able to pull it off, but they have daily updates and they look pretty good so far. And but if you go back to the 1958 Asian flu, and I don't know, I mean, I would think in the group that we have today, many people may remember the 1958 Asian flu. It actually hit in 1957. And in August of 57 in the US, and it really took off as schools reopened. And if you were to take the number of deaths, it killed about 100,000 people in the United States in 1958. It didn't get as much coverage because we were in the Cold War, and that kind of information wasn't shared as freely back then. But on today's population, that would equate to 230,000 deaths. And so I really wonder what happens when schools open up. Do we see this? And there's a lot of differences. That flu tended to impact young people more than older folks. But there's still a lot more that we don't know, and that's why I think we're going to have this bouncy swoosh along the way. If you look at some of the impacted sectors of real estate, hotels and retail space are the biggest immediate worry. That's where hotels are having a real hard time because business travel is almost 100% shut down. I travel usually 3 days a week, and I've been told that there'll be no travel, no in-person presentations through at least the end of this year, but probably till spring of next year. So business travel is kind of off the table. Leisure travel, hotels don't make as much money on leisure travel, but there's not a whole lot of that either. Brick and mortar retailing was already losing market share. It's lost a lot more. And I tell people that the department stores were going to go anyway. There's no purpose. Department stores do not serve a purpose in today's economy. The peak period for department stores was the late 1950s and the early 1960s. They've been losing market share ever since. There's probably no room for more than 3 department stores in the country, 3 department store chains in the country. I have said even before COVID that I didn't believe that there would be one enclosed mall in place anywhere in the United States by 2030. And I think that that's probably going to be sped up a little bit. There'll still be town centers and there'll be open air, but retail is going to go through a big adjustment, and it was going to happen anyway. It's going to be sped up a little bit. Apartments have done fairly well. They've done fairly well in Charlotte in particular, because we've seen a continued influx of young people coming to town. We're still seeing a lot of folks come here. The Wall Street Journal called me up wanting to do a story about all the folks moving to Charlotte from New York, all the folks in financial services moving to Charlotte from New York. They could have thrown San Francisco in there too, but there are a lot of folks moving here. I don't know that they'll hold up as well, though. We've got a lot of apartments under development. We've got a lot of office space under development. I don't buy into the notion that people are not going to work in offices. I don't see how you can develop and maintain a corporate culture without it. There's also been a lot of talk about people moving to the suburbs, and there is some of that. The demographics are helping drive that. The leading edge of millennials turned 39 this year, and so an easy way to think about it is the number of millennials reaching the age of 40 will increase every year for the next 10 years. As they're forming families, having children, they're doing it later in life. A large proportion of them will choose to live in the suburbs because of the lower cost of living. A large share of folks 25 to 35 tend to live closer into the city, areas like South End, ODOT, and I think that's going to continue. I've got a couple of charts here on the trends in COVID. This is about 5 days old, but the trends have continued. The number of cases, you can see the second wave of cases. It was primarily in the Sun Belt. It was primarily in big states. I mean, California, Texas, Florida, those are your 3 largest states. And so if it's going to take off of those states, it's going to move the numbers in a big way. But also Georgia, which it's the 7th largest state. So I mean, there's some really big states, and but the deaths did not pick up nearly as much. When you look at the deaths chart, and you look at the big spike that we saw earlier, most of that was in the Northeast, New York, New Jersey, Connecticut, Massachusetts. They account for about 17% of the population. They accounted for more than twice that as a share of deaths, even all the way to date. So on a to-date basis, so it was a much larger share back here. Looking at testing, testing is really ramped up. An average of about 750,000 tests a day, giving in the United States, and the percentage positive has come down to 6.6%. So the trends are moving in the right direction. We're having a tougher time than most other countries. Brazil and India are certainly having a tough time, but you would expect developing economies to have a tough time. I think a lot of it is in our nature. Our economy is a little bit different than many other economies. Leisure and hospitality is very large. Without giving you a whole story here, if you think back to, you go from World War II to 1973, productivity growth in the United States was about 3% a year, which meant that incomes could rise 3% a year. And so you had predominantly one-income households. With one-income households, the spouse could shop and it helped support retail. After the Arab oil embargo, productivity growth in the U.S. has averaged less than 1.5%. It's a mathematical identity, and productivity growth and wages have to grow at the same. And so wages have only grown 1.5% a year since 1973, after adjusting for inflation, real wages. And so what we've seen the growth of 2-income households. And with that, you saw the growth of things like Applebee's. I remember when I was in college and the CEO of Applebee's came and pitched his concept, trying to get people to come out and work for the company. It was before they opened their first store. But that's when, so leisure and hospitality, the restaurant business is much bigger. Going out and socializing and beyond your close circle of where you live is more common in the United States. In Europe, Spain and Italy were hit very hard by the virus. A vast majority of folks in Italian towns and Spanish towns never travel more than 30 miles away from the place that they were born. Never in their lifetimes. That's unheard of in the United States. People travel more than that often every day, and would not think about it for the weekend. So, we are in a different situation than many other nations, and I think we're going to continue to battle, which is why I've got this bouncy swoosh. This forecast that we have for GDP is old. We updated it last week. We're closer to 25% for second quarter. After today's housing starts number, it's probably going to be a little bit stronger than that. When you look at, let me see how I get back on this thing. That makes it worse. Let's see. That's not that hard. Consumer spending. This is something that's really kind of interesting. In terms of consumer spending, the peak in consumer spending before the recession was in February. And since February, consumer spending is down 6.6% in total. But spending on goods is actually higher today than it was at the peak of the business cycle. Spending on durable goods, which is cars and furniture, household electronics. I know I went out and bought a computer shortly before everything shut down. Non-durables includes a lot of food stuff, but also includes sporting goods, clothing, which nobody's bought anything on. Both of those are up. Services spending, which is predominantly healthcare and restaurant dining and travel, is down 11.6%. Now, I mentioned that when you look at spending, it's the exact opposite of employment. In terms of employment, higher income folks, higher employment among higher income folks who earn over $60,000 a year. And this is based off of research by Raj Chetty and their Economic Opportunity Project at Harvard. High income folks are basically, they're back at the same level of employment that existed at the peak of the last cycle. But low income folks are way off, and middle income folks are off pretty significantly too. But when you look at spending, low income folks have seen the biggest rebound in spending. So the folks that have been out of work, and the reason why is that the vast majority of jobs that have been lost in the economy have been low paying jobs. They've been jobs in the hospitality industry, and the stimulus, $1,200 checks, they replaced a very large proportion of the income that was lost and helped support that spending. But higher income folks really didn't get that boost, or didn't get as much of a boost from that, have a lower marginal propensity to consume. And so the way it is right now, this is the breakout on this. For low income folks, spending, overall spending, it's a slightly different measure from Harvard. It's down 8% from January as opposed to our measure from February. For low income folks, their spending is just down 4.2%. And that low income is income less than $27,000. Middle income, which is $27,000 to $60,000, is down 6.9%. And spending by high income folks, which is over $60,000, is down 11.5%. Really, really quite remarkable. And that is one of the reasons why economists are very concerned that we need to get something done to extend unemployment benefits. It doesn't necessarily have to be $600. It could be $400. I think we'd be fine. That's a $400 in addition to the state benefit. It could be $5. It could be $6. But something needs to be done there. The $1,200 checks, they would help. But the interesting thing about the $1,200 checks is that Ameritrade, Schwab, E-Trade all said they had a surge in accounts that were open in amounts of $1,200 or $2,400 after those checks came out. When you look at employment, you see the big drop that we had in April, more than 20 million jobs lost, 3 million, 2.8, 4.8, 1.8, or something like that. We've added about 40% of the jobs lost back. I mentioned the breakout on that. Employment appears to have bottomed on April 15th, right on tax day. You look at jobless claims, we get that data every Thursday morning. We had 16 weeks of declines, had a couple of increases, rather small, but it's trending back down again. In North Carolina, jobless claims peaked the first week of August. I'm sorry, jobless claims peaked the last week of March. They're down 90% since, they're down 90% through the first week of August. As I mentioned, housing has held up reasonably well. This is single family housing construction. It's our forecast going out through 2030. We had taken it down slightly in 2020, thinking that we were going to see an interruption as unemployment spiked, that you would see fewer people wanting to buy a home. After 9/11, we saw a nesting instinct kick in where people wanted to spend more time at home, more money on their homes, and buy more homes. I think that same thing is taking place now, where people are spending a little bit more money on their homes. If you're working out of an apartment and a lot of the apartments that were built with a lot of shared spaces, and those shared spaces aren't usable right now. If you don't have a balcony, I mean, you're probably hating life working out of an apartment. And what a lot of young people have done that I talk with that work with us is that they've left. They've left New York. They've left Charlotte. If they're in apartments, and gone back home and are working out of their parents' home, because the new modern apartments just don't have enough space for them to work. Small business optimism is surprisingly rebounded. It did fall this past month, but it's at 98.8. The long run average is 98. It throws people for a loop, because when they think about small business, they think about independent restaurants or bookstores or independent shops. But about 20% of small businesses are manufacturers, which are doing okay right now. Slightly larger proportion are construction firms. They're doing okay right now. They're doing more than okay. They're doing extremely well. And so that explains some of the bounce back in small business optimism. I spend a lot of time working with small businesses. We're the largest lender to small businesses across the country. And there is a wide variation within that sample, where manufacturers and professional services firms, if you're an IT firm and you're helping people set up remote working and remote learning, you're doing very, very well. But if you're a fitness instructor, you're having a hard time. If you have your own fitness firm, or you're having a real hard time making that work. Looking around the country, where the unemployment rate is the highest, tends to be in areas that are most dependent upon tourism. Our business travel, Nevada is the most intense. Las Vegas is most dependent upon tourism, both nationally and from overseas. We've got the highest unemployment rate at about 15%. Hawaii's at 14%. Florida's at 10.4. The other thing that stands out are the states in the Northeast. New York at 15.7, New Jersey 15.6. Connecticut is a little bit lower. Pennsylvania 13%, Illinois 14.6, Michigan 14.8. All of these states have been slower to reopen their economies. I've left out Massachusetts 17.4. These are not tourism hotspots. Business travel is pretty important for those markets, though. You're not getting that business travel. The other one that jumps out is California, and I really fear that California is getting ready to go through the same sort of rough times that they faced back in about 20 years ago. I mean, we got the blackouts. We've got just an accelerated exodus out of the San Francisco area and LA. COVID problems really bad in Southern California. And folks are leaving. They're predominantly going to other Western states. Phoenix is a big winner. Salt Lake City's a big winner. And Texas, a lot of folks going to Dallas and Austin. The other thing I'd tell you about Austin is that it has or is developing the same kind of ecosystem for the tech sector that exists in Silicon Valley. I don't know that there's another place in the country. I used to tell people the only other place that had an ecosystem similar to Silicon Valley, really in the U.S. was North San Diego County and Tel Aviv. Those were kind of, so it was Silicon Valley, North San Diego, Tel Aviv were your big tech centers, but Austin is definitely it right now, and you can feel it when you travel there. And there's pitches going on in hotel lobbies, and it's just it certainly San Francisco's got some real competition for its most important industry. Now turning to North Carolina, this is where I say you can see a little bit of a V-shaped recovery, if you want to call it that, because very strong rebound. We lost. I'm trying to think of what we lost in terms of jobs right off the bat, but we're seeing the same thing that the nation is, where the bulk of the job loss has been in low-wage jobs. You can see that when you look at leisure and hospitality, about 40% of the job losses in the state, whereas financial activities actually show a slight increase in employment since February over the last 3 months. So it's kind of interesting to see that what's happened there. In terms of job losses by income cohort, low-wage jobs are down 12.8%, mid-wage jobs are down 7%, and high-wage jobs in North Carolina are up 1.8%, using that same breakout, up 1.8%. So it is the most unusual recessionary environment I've ever seen. Looking at COVID in North Carolina, it's a little different here. That we saw a slow, steady climb in COVID cases. We didn't see a first wave and a second wave. It appears to have crested, somewhere in early to mid-July. And we've seen that the number of cases has come down, although the number of deaths is still rising in North Carolina. Mecklenburg County had a sharper relative increase, the same basic trend as the state, and we've come down quite a bit. The profile of cases in Mecklenburg County tends to trend younger than it does statewide. One of the things that we've come across, or that's come out of the COVID crisis, is we are getting all sorts of data from people like Google and Apple and Homebase, and that give us data on the number of people that are asking for directions. And you have the number of people that are asking for directions to go to recreational places, retail and recreational places. You can see the recovery here. In North Carolina, it's down 11%. In Mecklenburg County, it's down 20%. In Wake County, it's down 22%. It's down more in the big urban centers than it is in the smaller centers. It's not down nearly as much in Asheville or Winston-Salem or Greensboro. When you look at what's up in the state, on a statewide basis, directions to parks is up 65%, because with healthcare workouts facilities largely shut down, people want to get out and work. To residential areas, so going over to visit friends, they're up 8%. Those are the only things that are up. Transit is down 24%, and directions to workplaces are down 34%. So that kind of gives you an idea, and you see how this breaks out. That's a statewide. In Mecklenburg County, it's down 39%. In Wake County, it's down 40%. Same basic trend that we saw in retail, or Mecklenburg and Wake have been hit a little bit harder. Looking at Charlotte job growth, it's hard to see the rebound here. We have seen a little bit of a rebound. We lost 178,000 jobs in March and April, and we gained back 60,000 jobs, about a third. Employment is now 90% of what it was in February, that is still worse than it was at the worst part of the Great Recession. So kind of give it perspective. Again, most of the job losses are in low-wage industries, so the hit to income has not been as great. Most of that has been at restaurants. Office employment in Charlotte. So, you know, your finance, your professional services, utilities, it fell by 24,000 and it's come back by 7,000. So the percentage is a little bit not as great of a rebound, but it's only down 4.9%. So if, you know, in terms of the number of professional workers that are out of work, it's about half as bad as what you see for the economy as a whole. When you look at what's happening in the housing industry in Charlotte, single family housing has picked up. Apartment construction is still very strong. When you look at the number of people moving for jobs within the United States, Charlotte ranks number 2 behind Austin. And there's a pretty significant distance to number 3. This is not, you know, this is some data that we get from LinkedIn. And that's helped support the apartment market. It's also helped to support the single family market. Single family starts are up 7.7%. Apartment construction is actually down because last year was a record year for apartment construction. Home prices in Charlotte are rising faster than they are in the US and about 2 percentage points faster than they are in North Carolina. Got just a couple of charts here on Israel. Their GDP came out this morning. The second quarter GDP came out. It's basically following the same pattern as the US. They had a 6.9% decline in the first quarter. Israel reports GDP like we do in the US. They had a 28.7% annualized decline in the second quarter. I think Germany had like a 10% or 10.4% decline, but that was unannualized. So that would have been a 43% decline. Germany's economy declined to a 43% annual rate. For the year, the Bank of Israel revised their forecast this morning. They're looking for a decline somewhere between 4.5% and 7%. In the US, we're looking for 5.5% decline. Goldman Sachs updated their forecast. They're looking for a 5.5% decline in Israel's economy. Israel is very dependent upon tourism, and they are very dependent upon exports, particularly of tech goods. And with the global economy slowing, exports have really slowed. Israel's also had to deal with a second wave of the coronavirus. It coincided with the reopening of schools. And a lot of people, when something coincides with something, they say, oh, that's it, and that may be it. But we also saw coronavirus pick up in the Palestinian areas, which didn't reopen schools. We saw it pick up in Saudi Arabia, which didn't reopen schools. It's gone nuts up in Lebanon and gone further nuts. So in the countries that actually can't report data in that neck of the woods, everybody saw it go up. So I'm not quite sure that was it. It may have been. COVID does share some similarities with the Middle Eastern respiratory syndrome that we had a few years ago. Looking at exports in Israel, you can see how much they've come down. Not a total collapse. The tech sector has been pretty strong. Defense and security has been pretty strong. So it's been somewhat resilient. Unemployment in Israel is still relatively low, 4.5%. Very expensive place to live, and that the labor market is perennially tight. And the stock exchange in Israel has held up reasonably well, although it has not done as well as the U.S. So let me talk a little bit about where we're headed, and then we'll open it up for questions. I think that after that, given the pattern of economic growth that we've seen, with strong rebound in May and June, and then as the COVID cases came back, we saw economic engagement pull back. My sense is that we'll probably have about a 25% increase in real GDP in the third quarter. The fourth quarter, though, if the reopening of schools goes poorly and comes undone, and it causes consumer engagement to pull back, then the fourth quarter might be a little bit soft, but soft in a relative terms. It'll still be up 4 or 5%. Next year, we're looking for growth to be up 4 or 5%. These numbers sound really good, but we will not have recovered the drop in output. We don't expect to recover the drop in output until the spring of 2022. Now, one of the things that has gotten the stock market up there was a piece by Goldman. It actually came out like 3 weeks ago, and it talked about some of the optimism on vaccines. And I would say that our forecast is roughly consistent with theirs. We don't tout it too much this way, but there are 3 vaccines that are in stage 3 trials. We'll probably get results on at least one of them by mid to late September, so about a month from now. They've got Operation Warp Speed, where they are manufacturing the vaccine already, and it is very possible that we will see some vaccine administered by the end of this year. But that's in our forecast already. I mean, maybe not the end of this year, maybe it was January, whatever. We've got it in there. COVID's not going to be behind us. I mean, they figure that it'll probably take 2 shots per person. They don't know whether it will provide lasting immunity. The first folks that'll get it will be first responders, the healthcare folks. I don't see us putting COVID behind us until the tail end of next year at the earliest, probably 2022. And that's if everything goes right. I mean, it is very promising. We've got over 150 vaccines in development, 3 very promising ones in stage 3. 1 vaccine has been approved for military use only, and given that the military still has some outbreaks, it's probably being used selectively. So I do feel like there's a very good chance that we're going to get that. The stock market seems to be rallying in anticipation of that. If we get some bad news on the vaccine, I would think the stock market would sell off on that. So let me stop there. I know that's not everything, but we'll get to that in the Q&A.
Excellent, Mark. Excellent presentation. Tell you what, let's see if we can start populating some questions in the Q&A. I'm going to check in. I don't see on my settings the hand raising, so I'm not sure. I know that we had a number of questions in Q&A in the chat part. So let me see if I can
Bishop, do you want me to read a few questions from the chat box, or people can message me and I can feed them to you and Mark?
Right. So one of the questions that was asked was, will the presentation be available after tonight? And we are going to have, we're recording the Zoom. So the presentation can be available for replay, and that's how you can see it. I haven't checked with Mark yet to see, because of copyright considerations with Wells Fargo, whether it's possible to have the presentation released subsequent to that. I don't think we have an answer for that tonight, but we'll look into that. So we have one question from Stephen Phillips. Can we open Stephen's mic and Stephen can ask the question?
It's open. Mark, since you, Bishop has kindly introduced you as the futurist and all-knowing person, I have a question on the technology sector, which has certainly been hot for a long time. Do you see that continuing with all that's going on in the COVID world? Is that helping or hurting?
Well, we are seeing that a lot of gains in technology. A lot of the fastest growth has actually been in areas like that are either Amazon or Shopify, which have, their stocks have gone crazy, are folks that are in that, which is, using technology to provide goods and services more efficiently. I think that the biggest driver for technology going forward is probably going to be 5G. As the rollout of 5G progresses, I mean, I know that phones, on my phone it says 5G, but I don't have a 5G phone, so it's not really 5G. But there's going to be a whole upgrade cycle on phones and laptops and tablets and things, and so that's going to be really good. If you've had a traffic accident in a relatively new car, just a little fender bender, you find out how many sensors are in those cars and how many sensors have to be replaced. I mean, all that stuff's made by Intel and AMD and a couple of, so technology is becoming more and more. It's in our lives more and more. It's not gonna. I don't see it slowing down, but I think 5G is probably the next big thing. And the other thing is synthetic biology. It's CRISPR and things of that stuff. It's amazing how quickly they were able to map out the genome of this virus, and I don't know whether that's going to give us a good vaccine. I hope it does. It looks promising right now. So, but all of that looks very, very good, and that's been a large part of what's been up in the stock market. But I feel very optimistic about that going forward.
Thank you, Mark. And
Thank
you, Bishop.
Thank you, Stephen. Dave Press has sent a question in by chat. Can we open up Dave's mic and let Dave ask Mark the question?
Hi, Mark. I was curious when you were talking about the spending trends among the low, middle, and higher income households. Why you believe that spending is down so significantly among high income households as compared with the other two?
Yeah, I am not sure why it's down as much. My sense is that for higher income households, purchase decisions are more discretionary, and so they don't they don't have to. Whereas for lower and middle income households, they need to buy stuff. They've got a lot of pent up demand, and I think that's probably all there is to it. And that higher income households are probably staying closer to home. Higher income, and also as wealth increases, you tend to spend more of your money on services as opposed to goods. And so I think that the big swing has been in goods purchases. Services prices are down, so I think wealthier folks they'd like to spend more money on traveling or some sort of service, dining out. And while restaurants are open and takeout is available, when you dine out, if you go to the Fig Tree, you're going there for the atmosphere. You're not going there for you are going for the food, but the ambiance is a big part of what you're paying for. So I think that may be why it's down as much. And to give you some perspective, spending on services accounts for 2/3 of overall spending, and goods is the other third. So and so that's for the economy as a whole. But it skews higher for higher income households spending on services.
Okay, let me, we have some questions building. We have a question from someone named iPhone. I don't know who iPhone is, but if
he's a new Temple member, he just made a big donation.
Can we please identify yourself and ask your question?
Might not know who he is. He might not have known.
All right, well, let me pose it then. The question was, how much does the president actually impact the economy and the markets?
Now, our president, he certainly has some impact. I mean, so, you know, yeah, I've always said, I said early on when Trump came in, I said, you know, because I was asked on the nightly business or nightly the news hour. They said, well, how much credit should the president get? And I said, listen, I said, presidents get all the credit, should get all the blame when things go wrong, so they should get all the credit when things go right. And I just kind of left it at that. I mean, that's just kind of, but they have limited control in the short run. Now Trump did one very good thing. I mean, you know, without, you know, that did boost growth in 2017 and 2018, and that was a significant rollback in regulation. And regulations are done through the through an administrative process. So most regulations do not have to go through Congress. And so that is the one way that a president can influence the economy. Almost everything else in economic policy, the president can weigh in on the shape of a stimulus bill or the shape of the highway bill, but they don't propose the legislation and they don't do it. But the one thing that they really do have a lot of control over is the regulatory environment. And I wrote a paper that was published in 2019 that highlighted the decline in regulation and the rise in manufacturing activity that we saw. And the period 2017, 28, and 2018 was the strongest 2 years in the U.S. manufacturing sector since 1969. So that rollback in regulation really did have an impact. So that's something that's the one place. And so when people ask, well, you know, if Biden gets in, you know, how would that differ? I said, well, in the first year of a presidency, you think about it, you're trying to get your cabinet approved through Congress. You're trying to lay out what you want to do and build the support to do it. So there's very little change in policy, but you can influence regulation. If Biden wants to shut down fracking, for example, he really can't shut down fracking. But what he could do is he can make it harder for people to begin new fracking operations on federal lands. So he could do that, or he could make it more cumbersome to get pipelines approved, although they're pretty cumbersome as it is. But that's where the impact would be in the short run. There's also some confidence figures in there, and you know, with Trump and his tweets, he introduced a level of uncertainty in the economy from time to time. And you know, the less he does, the more certainty there seems to be in the economy.
We have a batting order now. I'm going to tell you the people who are in the queue, and we'll go to them. I just want to mention, I read that paper that you published a year ago, early 2019.
January 2019, yeah.
Yeah, on the it was excellent. And when Mark had a list in there of all the deregulation that Trump had done and the impact that it had on the economy, you could chart it. I think it was a timeline chart in there. We'll try and get a hold of that paper and distribute it upon request, if that's okay with Mark.
That's fine. It's fine.
It's a worthwhile read. All right, let's go to some questions waiting. We're going to go to a question from Jeffrey Laurie, then to Matt Zadinsky. Matt, only one of your 2 or 3 questions, then to Lawrence Haynes, and then to Janice Weiner. Let's start with Jeffrey Laurie.
Hi, how are you? I was just wanted to maybe get your view on, you know, the fact that the economics of what's going on with COVID seem to be starkly different depending on where you fall on the economic ladder. Do you see maybe either a shift to the left, based on, people who are less well off losing work? Or do you see that maybe not having as much effect given the markets continue to do well? What are your thoughts on that?
Well, yeah, economic inequality has gotten a lot of attention, and there's so much more data out there today than there was previously. I'm not sure. I would think that it would probably get more people, have more people supportive of some of the left-wing proposals. Unfortunately, a lot of those proposals are not going to help the situation. So that's one of the reasons why we have this pendulum that swings back and forth, because we say, well, let's try this, and it doesn't work. Like, for example, raising the minimum wage is not really going to do anything to help economic inequality. It's not going to solve that problem. The bulk of the problem of economic inequality comes from the education system. And where I get really concerned is that if you go to private school, your school is probably operating at a much higher level today than public school is. And even if you're doing remote learning, it's probably operating at a much higher level because they don't have the bureaucracy that the public school system does. I mean, it's too hard to make all these adjustments in the public school. I think that given that this is going to go on for a while, that economic inequality is likely to widen. But that's where the issue is. It really comes out of a lack of education, lack of job training, a lack of awareness of how soon in life that you need to start thinking about developing skills that'll make you more employable. So I'm concerned about that. That's again, COVID is disproportionately impacting mostly minority groups. Either it's Latinx, I've got to get used to the new term, and African Americans, and so it's disproportionately impacting the folks that are already struggling with economic inequality. So there's not a real simple solution to this either. But if it was me and I was the czar or I was the governor, what I would do is I wouldn't have every student in public school on the same server. I wouldn't do that. I wouldn't even have every student in Mecklenburg County on the same server. I would try to break it up so that break it into smaller pieces, and it might be a little bit more serviceable. But fixing education is a generational thing. I'll tell you just real quickly on the unemployment rate why that doesn't, not unemployment, why the minimum wage doesn't work. In that, my first legal job was a dishwasher. I worked off the books as a busboy and dishwasher when I was 10. Got my first legal job when I was 12. And that second week at work, I remember someone joined me in the dish room at the Lark and the Dove in Atlanta, and he had just gotten out of jail 3 o'clock that afternoon. And if you have a low minimum wage, it allows for a lot more second chances. It allows for employers to take a lot more chances on folks. If it's $15 an hour, you're not going to get those second chances, and you get people shut out of the economy. I guess they took a chance on me, on this 12-year-old kid that showed up with his friend to get a job that day. But that's what a low minimum wage allows more people. The most valuable work experience you get is having a job, showing up, and learning how to listen to your supervisor. I mean, that's the first skill you need to learn, and it'll carry you for just about everything else.
It's a great answer. And let it be known that Mark never had to go back to jail after that. Let's move to Matt Sadinsky. Matt, please ask your question.
Hey, Matt. How are you?
Here. Hey, Mark, and thank you, Bishop, and thank you guys for doing this. So after the Bush presidencies, President Obama took over in a time of tremendous financial uncertainty, And certainly with what the economy's doing and this COVID and Black Lives Matter and cities in tumult, isn't it true, Mark? Wouldn't you agree that no matter who wins, Biden or Trump, we may be looking at an economic recession? It's going to be a mess for whoever the president is.
Well, I mean, the weird thing is that the decline in a recession is the decline in economic activity. Kind of to put it in simple terms, if you were walking down the road and you were on your iPhone, you weren't paying attention, and you fell into a hole, the recession would be when you were falling. When you hit the bottom, that's the recession's over, and the recovery is when you're crawling out of the hole. We fell in the hole in 5 weeks. We fell more than we've ever fallen. Any recession outside of the Great Depression, we fell at a faster rate. But we stopped falling, and now we're recovering. So I don't know, even with all the problems that we're facing, I don't know that we're going to have another recession, in the next few years. I mean, I think the business cycle, the time that we go between recessions, used to be about 5 years, really 4 years, and then in the 1980s we had a very long expansion. In the 90s we had a really long expansion, and the last 4 expansions have averaged about 7.5 years. So given that this one was real short, we didn't have any imbalances, it could be a while before we have another recession. And it's going to take us another couple of years to climb out of the hole. So it'll feel like a recession because we have high unemployment and a lot of displacement, but we will actually, things should be getting progressively better. And, that's what, so when Obama became president, the recession ended in August of his first year. So it ended in August of
2009.
Yeah, August of 2009. I was trying to get the math right. God, it seems so long ago. So it's so it ended relatively quickly. It didn't feel like it to a lot of people because the economy was growing very slowly during those years, and we did have a couple of quarters where we had a decline, a small decline in GDP, but not a renewed recession. It's just a very slow recovery.
I did, in the batting order, I skipped over Jim Stoner. Jim, you had a good question about the stock market. Could you please ask that question? Is Jim with us?
Sorry about that.
Okay.
Sorry about that. I had to unmute. I basically, I think of the stock market as a leading indicator. It's kind of like the pulse of what the investor thinks what's going to happen. And I'm afraid that if we talk about serious tax increases in light of trying to recover out of this pandemic, that it'll stifle the stock market. I don't know if it'll slow down the recovery, but it'll definitely, I think people, well, you may see a lot of capital gains before the end of the year for people trying to get in under the tax change. But if they change the taxes in 2021, that'll probably still fend off the investors. I don't know if it'll be enough for worldwide, whether investors will start to move away from the United States, move away from the dollar. Although the dollar's been dropping. Maybe Mark can talk about the dollar too.
Yeah, I'll tell you, there's a lot. I'll unpack that just a little bit in terms of stock market. I share your concern if we have too much reversal. I think there is there's a tendency on the left to look at capital gains taxes and dividend taxes to say, well, we should tax those the same as ordinary income. And the reason why they're not taxed as ordinary income is you want to have an incentive for people to invest in the economy. If they didn't have an incentive to invest in the economy, they would just go out and spend the money on goods and services, and it'd be gone. and the capital stock of the economy wouldn't grow. And I think that folks on the left understand that. They don't know, what to some extent, but I think the capital gains and dividend rates should be higher than they are. What I wish would happen, I wish that we would have changed the systems to encourage more long-term investment and have a lower rate on capital gains for assets that were held for 3 years or more, somewhat higher rate for 2 years or more, and then a higher rate for 1, and then it's ordinary income for stuff that's held less than a year. I think it would be beneficial to encourage long-term investment. And I think I remember I was at a meeting with Obama's people, and they were like, they thought that was great. And so that the Republicans wouldn't go for that. It would seem to me that there would be more agreement on something like that. I don't think that's what's going to happen. I would think that right now the consensus view is on the election, and it can change. After the last one, I don't want to make any predictions on the election, but I'll tell you what the market's view is that Biden will win, and Democrats will either gain control of the Senate with a narrow majority, or the Republicans will maintain a small majority and maybe a 1-vote majority in the Senate. If the Democrats were to win a large majority in the Senate, I think that's when you would get where you would see a lot of people rushing to take capital gains. I think that's what would give us that. Now, the strength that we're seeing and the weakness that we're seeing in the dollar is somewhat concerning to me. I refer to weakening of the dollar. I refer to it as the high that a crack addict gets, and I only know this from drug supervisory training, but evidently the high that a crack addict gets, it burns the pleasure sensors in the brain, and that's one of the reasons why it's so highly addictive, because they have to use more and more trying to get the same high. Well, that's the way a cheaper currency makes U.S. goods, U.S. exports more competitive. And, so in a way it boosts our exports and it makes it look like, but in order for that to be sustained, it has to get cheaper and cheaper and cheaper. And it also raises the cost of imported goods, so it lowers our standard of living. It makes it more costly to service our debt. And, we've got a monster debt. So if I would watch the dollar very closely, if the dollar weakens and you begin to see it weakening where it's beginning to get headlines, I would take that as a sign to lighten up on the stock market, because the stock market will come down. That's what happened in the '87 stock market crash. The Federal Reserve was raising interest rates. They were trying to defend the dollar because the dollar was weakening too rapidly, and they're not going to be able to raise interest rates in this environment. And so that's something to keep an eye on. Right now, I don't think that's something that's going to happen, but it's one of the things that I'm watching closely.
Yeah, I was concerned with hearing people. Goldman Sachs, I think, recommended buying gold. So did a number of other people, and that always, to me, that's a negative thing. If people are equivalently going to the mattress, they're going to buy gold, so they figure that the dollar will no longer be any worth anything.
I would explain something though here on when Goldman was not telling ordinary people to go buy gold.
Right.
This was a trading strategy in that, and so these are highly levered bets that because interest rates are low and the Fed said they're going to keep them low, that the opportunity cost of holding gold is relatively low, and the dollar's weakening. So they're betting that gold is going to shoot up. It'll probably come back down after that too. But I would not advise individuals to buy gold because there's very high transactions cost, and you'd have to time it perfectly, and you're going to get clobbered in the transactions cost. But that's a trading strategy.
Also, that report, if I'm not mistaken. It came out in June. That was part of the hedge strategy. That was not an absolute trade. Jim, thank you for those questions. Let's move it along. We have two questions involving China. The first from Lawrence Haynes, and then we'll go to Janice Weiner. Lawrence, could you ask your question regarding China?
Yeah, sure. Do you think this pandemic is going to influence our dependency on China? I mean, for example, we couldn't get PPE because it was all coming in from China, and now there's an abundance of PPE being made in the U.S.
Yeah, I do think that, you know, there's one area that is very concerning to me, and that is that many of the active ingredients of the medicines that we take, everything from Tylenol to blood pressure medicine, are made in China and India. And actually, they're kind of made in both. I mean, they're made in China and sent to India for more processing, and then made into pharmaceuticals either there or in other parts of the world. The problem is they don't have ultra pure water. They have polluted water. And most of the medicines that we take today have carcinogens in them. So it's you know, they're not at a high enough level that we tell you not to take them. But if you take blood pressure medicine, if you take topiral, it's contaminated with carcinogens. So I do think that there's a health need that existed before COVID that we need to bring that production back to the U.S. They are doing that. PPE, you know, works out very well with a lot of textile companies. The Hickory area has really kind of set out to make themselves a destination for folks that want to bring production of PPE back to the U.S. And they've done fairly well there, although the dollar numbers are relatively small, the job numbers are relatively small. But we are seeing that come back, and I think that you know, while I'm somewhat optimistic about a vaccine in the very near term, you know, you think back to that Asian flu in 1958. We had a relapse 10 years later in 1968. Wasn't quite as bad, but and so I think it's, you know, very likely that that given how connected the global economy is, that we're going to be dealing with something maybe not quite as bad as COVID, about once every 4 years. And
you hear that?
And so
Sorry.
so I think that that makes it real important that we bring production of medicines and PPE back to the U.S.
You know, that's a good lead into Janice's question, because we have shipped so much of our production, not just PPE and medicines, but everything to China. And Janice had a question about the impact of COVID. Janice? You can unmute your mic. Is
Okay,
Janice
can you hear me
still with
now?
us?
Yes, there she is.
Ron Weiner, and thanks to everyone for putting the program together, and Mark, fabulous. My question is very similar but broader in terms of supply chain issues, the impact of COVID on China's position long term, and even more broadly than just the U.S. Are other major trading partners with China giving second thoughts to relying on China to the extent that that they are? Do you think?
Well, you know, there have been huge supply chain disruptions. The last presentation that I gave was to the International Glove Association, which is an old relationship with First Union and Wachovia, because most gloves used to be made here in North Carolina, and gloves are made, I mean, these are gloves, everything from gloves that you would buy at an apartment store to what you would use in a nuclear power plant to handle hazardous materials. So much of that's made in China. And, you know, what I was hearing from those folks was that we we're talking about mainly the supply chain disruptions in China and how, you know, the factories were back open, but the workers weren't coming back or weren't able to come back. So there are huge supply chain disruptions in China, which they still have not gotten over. So that's still a big issue there, and folks are looking to build some redundancy in their supply chains. And this is something I tell people that one of the things that happens in recessions, and one of the things that happens when you have a traumatic event, is that people look to make their business model more resilient. And trends that were in place previously tend to accelerate. After Fukushima, a lot of manufacturers are saying, hey, we can't have all our supplies coming out of one district of Japan. We need to have some redundancy in our supply chain. And with China now, a lot of folks are looking at that. And so I think that marks a permanent change. In this paper that I wrote, which is it's a fairly easy read, one of the things that I pointed out about the rebound in manufacturing was the reason that industry was coming back to the United States is that folks wanted to have more control over the supply chain. Makes it was, you know, after Fukushima. But the other is that the labor content in making just about anything has diminished to the point that there's really not that much cost savings to producing stuff in China. And so the relative cost savings is smaller. There may not be enough cost savings to make it worth the added risk to your supply chain and your business model. And so that's why I think that the reshoring of manufacturing is going to be much larger than people expect. Unfortunately, most of the industry that's coming back doesn't employ large numbers of people. So it's very highly automated. Adidas makes sneakers in Atlanta. So, I mean, you know, it's like, I mean, we weren't making any sports shoes in the United States, and they're making them in Atlanta. It's a highly automated process.
Let me go. We have 3 questions left in the queue, and you all have been very patient. Mark has been very generous with his time. Dave Press had a question on trends. David, can you open your mic and pose the question?
Sure can. Mark, I don't know if you have data on this, but I'm curious, given what I do for a living, if you're seeing any trends in terms of charitable giving and philanthropy this year. And by the end of this year, you know, knowing that most giving happens in the fourth quarter, if you anticipate the giving will be up, down, flat, and then also looking ahead to 2021 with whatever goggles you can put on to predict the future, if there's any predictions for next year as well.
Now, if the stock market stays up, I would think that we would have a fairly good year in charitable giving. It would. I just, you know, given all the uncertainty in the economy, it's not going to be that good. But I think it'll certainly be a lot better than it would be otherwise if the stock market holds up. And I really don't have a good view on 2021. It's encouraging that upper income households have held up reasonably well so far in this recession. But I do think that that's changing somewhat. I mean, the banks knew that the optics of laying off workers was not good. And a large proportion of workers in the financial services industry can work remotely. As we see credit losses increase and profits come under pressure, we may see more job losses among higher income households. So even though I don't think we go back into recession, we could still have some rough periods. So I would think it'll be fairly challenging. I mean, I think that it's important to remind folks about donor advised funds, and that it's a great way if you've got some capital gains, some unexpectedly large capital gains, and you can put those in a donor advised fund and get a nice big tax break. So and the other thing that I like to tell people about, it sounds really technical, but if you say you bought a stock in XYZ Corp and it's up, it's doubled, you could write a out of the money put on it, donate the appreciated stock, and have the stock put back to you probably at a lower price. You know, you get the write-off of the stock, you get stepped up basis. So I mean, I would be trying to make people aware of that, of those types of things. You know, to get folks to take advantage of the appreciation of the stock market.
We have two questions that I see in the queue. Let's go first to my very financially savvy friend, Howard Epstein, and then come back to a question from Tammy B. Howard?
Thanks, Bishop, and thanks, Mark, for doing this for all of us at Brotherhood and the Temple at large. And I remember you've done it for several years now, and I remember back in 08, 09, during the bad recession we had then, that you were pretty pessimistic at the time when you came and talked with us. It's encouraging that you're a little bit more optimistic now going forward. I like that. So my question is just, I'd like your thoughts on a couple things. Number one, I like your thoughts on the possibility of negative rates, like your possibility on inflation in the near future. And the other thing, and this may be out of your bailiwick, with the unrest in many of the cities in the country, with the COVID stuff going on, inequality, Black Lives Matter, and all that kind of stuff, what you see in Seattle, Portland, Chicago, and the report that came out today from the Mecklenburg County Sheriff about gun permit requests in June and July were at the level of the first 11 months of 2019. People wanting to get guns and things like that. I don't know if you have a thought on that or not. I'll turn it back over to you.
Yeah, you know, yeah, certainly all those. Now, back in 2008, I think we had something like Surviving the Storm. I remember that at Temple Beth. And you know, I think that, you know, we were probably appropriately pessimistic. I mean, we were looking for that long haul of a recovery. I mean, you know, now, you know, there is an awful lot there's an awful lot that's going on in some of the cities. I think that the cities that are broken are really going to struggle, and I think San Francisco, Seattle, New York are broken, and their governments are not instilling confidence in business leaders. St. Louis, I'd say, is broken. I'm not, you know, I don't have to make a big leap here. Centene Corporation made it pretty clear when they set up operations in Charlotte that you know, they might move the rest of the company if St. Louis doesn't get their act together. So, you know, I think we're likely to see an accelerated movement away from some of these problem areas. They may go through a period of decline and then come back again. You know, New York is an interesting one. All the young people have been wanting to go to New York. I mean, we in our investment bank, we train everybody in Charlotte, and they go out wherever. They can stay here. They move to New York. They go to San Francisco. A lot of the young people have been wanting to go to New York. You talk to them now, they're like, oh, well, maybe I'll work out of Charlotte for another year and see what happens in New York. That's what they say. They're like, I'd rather work out a year instead of go up there. So, I mean, there has been a pretty big exodus. If you look at what's happened to apartment rents, the only place in the country that they've declined in a huge absolute sense is New York and San Francisco, declined a little bit in LA. The largest increase in rents since the pandemic has been in Charlotte, Nashville being number 2. So it's, which is surprising to me because I know a lot of folks do apartment business and they don't have a lot of power in rents. I suspect the reason why we've done so well is we've got a lot of new apartments that have come up. In terms of the guns, you know, it kind of goes with, you know, the rise that we're seeing in violence. I think that it'll subside somewhat because I do think it's limited in particular circumstances. I don't get in a lot of details, but I've had 2 times in my life where someone's pulled a gun on me and I didn't have a gun. And, you know, I think that if I had a gun, it might not have ended as well. So it's, so, you know, it's, so I, you know, it is, so I, you know, I think that a lot of people are going out there and buying guns, be great for the shooting ranges. Hopefully everybody gets trained, but I think that will subside as folks recognize that it's really not going to be the answer for them.
It's a good answer. I rely on Howard as my security. Let's go to.
Sorry, Bobby, Bishop. Just I wanted to hear Mark's thoughts on inflation and negative rates.
Oh, yeah, I'm sorry. I forgot about the first one.
Okay,
Let me
all
finish
right,
that real
and
quick.
then we're going to go to
Yeah.
our last question from
Yeah.
Tammy B. Go
I
ahead.
don't think we will have negative rates. The Federal Reserve has made it clear they don't want to go there. They didn't work very well in Europe. I think that negative interest rates on a policy format are just like putting up big billboards that said, my God, we're in a hell of a mess and we don't know what the hell to do. And they just don't instill confidence. That's not to say that we won't see a situation if things get really crazy for some reason, like we saw in 2008, where Treasury yields temporarily went negative for a very short period of time. That's possible. I don't think it's going to happen because I think we're kind of past then. I also don't think we're going to see deflation in the very near term. And this is a big hit to global incomes and global wealth. And so it is a disinflationary event, but over the long run, it is an inflationary event. And you know, I've invested a little bit in some commodity ETFs. I would caution you in investing in them because there's all sorts of derivatives in them, and you know, it's very hard to find a pure commodity thing. I found one that kind of looks like it's. I'm thinking about ag and industrial commodities more than the gold and oil, but but I think that we're likely to see a mild inflationary shock over the next decade, where inflation may be, you know, in the 2.5% to 3% range.
That's a good answer. Let's go to Tammy B. She's got a topic we used to talk a lot about, but haven't heard much about it lately. Tammy, can you open your mic, please?
Yeah, my name is Tammy Brown. And, you know, I remember back in the 80s, you know, when we talked a lot about the economy and about paying back the national debt and how important that was. And then it just kind of went away, you know, and then when they decided to give all this money out to people because of the COVID, they just added to our debt, but they never really talked about it. What is all this going to have? Like, what kind of impact is that going to have on our national debt? And what ultimately is that going to mean for us? I mean, in our lifetime, maybe nothing. I don't know.
Well, I don't think anybody really knows. I mean, I haven't heard a very good answer on this. It scares me in one very near-term sense is that folks look at this and say, well, wait a minute, we just increased the debt. We ran $3 trillion deficit last year. Why don't we do that again? And think that it's okay and that there is no repercussions. But there are repercussions. I mean, servicing the debt, even at today's low interest rates, is going to be very challenging. And we're going to have to, and that's just, you know, that's just maintaining it at its current level. It's going to be very challenging. And we're going to have to find a way to raise revenues. And you know, I don't know exactly what that's going to mean in terms of taxes, but we'll probably have to look at changes to the tax system. That'll be a drag on overall growth. If you remember, the Erskine Bowles was going around, it was probably 10 years ago, talking about if deficits get to be over 100% of GDP, and then it's very difficult for an economy to grow faster than 2% on a sustained basis. Well, we're going to be there. We are there. I don't know. There's no quick solution to it, but at a minimum, it means that we have less money to spend on education and spend on infrastructure and spending on things that would allow for the economy to grow faster. So, you know, we're going to struggle with this both short term and long term. The way to pay back the debt, the way is to get stronger economic growth. The way to get stronger economic growth is to boost productivity growth, and you do that through improving education. That's what happened after World War II. We had the GI Bill, and folks went to college. We had a very productive workforce, and employment income grew very rapidly. and the huge debt that we racked up to win World War II was worked down to a much more manageable level. So, you know, that's the key. It's very difficult, but I mean, I can leave it on this optimistic note. I mean, just think about it. If we could reduce poverty by 10%, and to get those folks that were living in poverty to be producers, and you know, and to have stronger income growth, that would go a long way toward working down the debt. I mean, so we need to find a way to boost productivity growth throughout the economy, and to get more folks out of poverty into more productive endeavors. And you know, there's an awful lot that we're learning on how to do that, but it's going to be challenging. And I share with you your concern about the national debt. One of the things that ever since the 401k came about, I said, sure, this 401k sounds really good. I'm gonna save all this money for retirement, and then we're gonna have this big debt. They're gonna say, hey, Mark, I need that money. I sure hope not.
These have all been terrific questions and excellent answers. Mark, and thank you so much for your generous time, and thank you all for participating, but don't go away yet, because co-president of the Brotherhood, Kent Novell, has some closing remarks and some previews of things to come. Kent?
There. I thought Keely
There you go.
would do that, and she didn't, so I did. What a great way to spend a summer evening. Thanks, Mark. Thanks for hanging in with us as long as you did. Thanks for coming back again. And thanks for your insights in English, which is wonderful from an economist. Brian promised that, and Bishop just mentioned that I talk about some things that we have coming up. Well, next up, obviously, are High Holy Days, and then Sukkot. Sorry, by the way, no scotch and cigars in the sukkah this year, but I promise I'll see whoever wants to go there next year, no matter what. We'll find a way. Right after that, though, on the 14th of October, join us for our next Brotherhood event, a panel discussion featuring Dr. David Weinrib, who's our own resident infectious disease specialist, and Gibby Harris, the Mecklenburg County Health Director. I'll bet you can guess what their topic's going to be. And finally, since we're not going to get a chance to visit at Temple at the holidays next month, even though it's a little bit early, Shana Tova Ubriah, our wishes for a good and healthy year for you and everybody you know. Stay tuned, October 14th, Brotherhood Presents Part 2.
Thank you, everyone.
Thank you,
That's
guys.
a great way to end it. And thank you especially, Mark.
Great programs.
Thank you. Good night, everybody.